Hey everyone, welcome to this video on protecting your wealth through a financial crash. Now today's video is going to be super important. As most of you know, the financial system is shaky, there's a crash coming, and I want to tell you how to protect yourself and profit from it. And if you stay to the end, I have a free guide that you can download that's going to make this way easier, so stay tuned. All right, everyone. So we are going to talk about something today that's super powerful. Now, it's not something that maybe everybody wants to hear, but if you've been paying attention at all, you understand that the financial system right now is kind of shaky, right? You see it in the headlines. You see the stock market's getting shaky right now. Obviously, the cryptocurrency markets have been shaky, but there is something much, much bigger brewing, and unfortunately, it's probably not going to be pretty. However, if you're paying attention, if you know how to position yourself properly, then you can use it to your advantage. As we talk about this wealth transfer, money doesn't disappear, it transfers. And when there's a big crash, unfortunately, a lot of people lose their money. However, that money gets transferred and there's a whole other group of people that receive it. So hopefully you can use this information to be on the receiving end of the next wealth transfer, and that's what we're going to talk about. Now, this is the third video in a series that I'm doing, and in the first two videos, we talked about how building real wealth requires luck and timing, because it involves technology cycles. We talked about money like energy, like I just said, it doesn't disappear, but it transfers. We talked about how understanding technology cycles is really the key for investing in them. If you can understand how they work, then you can make a lot of money investing in them. We talked about the next $100 trillion boom, and then each one of those videos had their own guides navigating technology cycles and the $100 trillion boom. So if you haven't seen videos 1 and 2, make sure you go back and watch those. But let's get right into this one. I have some really good stuff. I'm going to tell you at the end, it's going to get a little scary. Unfortunately, I have to give you a little bit of scare, but it's going to be good at the end, so make sure you stay tuned. Now, I do these things for you guys. I'm telling you what I would want to know if I was on the other side of the table. This is stuff that I've learned, obviously, and so this is stuff that I think is super important. That's why I want to teach it to you. As you know, I do this just to provide massive value. I'm not doing anything. I'm not trying to charge you for this, and I do it just for you. And what keeps me going is give me some thumbs up, give me some likes, leave me some comments. I respond to everyone. I love having conversations with each one of you to dig into these ideas further. So give me some thumbs up and getting right into it. So we have to go back to the beginning. I always do this, right? I need to go back to the beginning. I need to go back in history so we can understand where we are today, right? We can't just talk about what's going on now without really understanding it. And we can go back hundreds of years or even thousands of years, but really we're going to go back to 1913 in the United States. Now, I know that there's a lot of international people watching this, and I am kind of talking about what's going on in the United States. However, the reason why that's important for you anyway is because still today, the United States is the financial center of the entire world. So the majority of the world's finance happens in the United States. So U.S. financial policy matters. We're talking about the dollar. The dollar is the reserve currency for the entire world. So this all matters no matter where you live in the world. Now, going back in history, a little time travel here, 1913 is when the Federal Reserve Act came into place. That is when the U.S. government made this act. They put this act in to create the Federal Reserve. All right, now I'm not going to get into all these different theories and conspiracies and who owns it and all these things. However, it's a bunch of banks that own it and control it. It's not really the government, but it kind of is. I'm not going to get into that right now. That's a whole video on its own. You could read a book, The Creature from Jekyll Island, if you really want to know more about that. Okay, now, so 1913, they created this Federal Reserve Act. What the Federal Reserve is supposed to do, or what they try and do, is they try to control money, the money supply. More money, less money. More money, less money. And they control the interest rates at which it's loaned out. When they set the interest rates, that drives the market. All right, but the problem is that you can't really control it that well. It's kind of like trying to keep it within a range. So we're constantly going into boom and bust cycles. We create more money, we lower rates, we go into a boom. We raise the rates, we go into a bust. And they can't keep it on a perfect line. It's kind of like driving bumper cars, and they're bumping back and forth. So they're controlling the money supply, they're controlling the interest rates, and that's what's caused all the boom and bust cycles. Now, they have continued to increase the money supply. As a matter of fact, just from 1921 to 1929, which led up to the Great Depression, the money supply increased almost 62%. Imagine that. I mean, I'm talking about 8 years. The money supply increased 68%. So when they create 68% more money, imagine if overnight I gave you 61% more money. You would go spend it, right? Wow, we have all this. And what happens is when you create all this extra money, it produces what we call malinvestment. That's bad investments. This is what happens with the people that win the lotteries or the famous athletes that make all this money and then lose it. They do malinvestment. They got the money easy, and now they just start throwing it everywhere. Oh yeah, I'll invest in this, I'll invest in this, my friend wants this, yeah. And they do all this bad investment because it's kind of like free money. It's kind of like fake money. What it does is it leads to wasted capital. Instead of that capital being earned hard, I mean, if you had to work hard for that money, you're gonna protect it. You're gonna value it a lot more than if it was just given to you. And so when all this free money comes sloshed into the system, it creates malinvestment, and then it leads to wasted capital that could be used for better uses, and it creates all kind of economic losses. This is what leads to economic recession, in my opinion. Now, I'm sure I'm going to get lots of comments below, and that's great. Let's talk about that. So anyway, leave me comments. Make sure you give me a thumbs up. Now, the economic recession is necessary to correct this, all right? It's kind of like a forest. It's necessary to have a forest fire so that new trees and new brush can grow up. All right, so up until that point, up until 1929, this is what I believe caused the crash. Many people, especially if you've gone to college recently, they believe in Keynesian economics. We should always spend, not save. And they believe that it was capitalism that really caused this. I believe it was the creation of this money supply and this malinvestment that caused it. And we had the U.S. debt in 1929, so right on the brink of the Great Depression. The amount of debt that the United States had was 17 billion. Remember that number, it's an important number. So 1913, Federal Reserve Act was put into place. They were trying to control money supply and rates. They increased the money supply 61%. The debt rose to 17 billion, and then we had a crash. Now, things escalated really, really quickly, all right? So from 1929 to 1971, that's 42 years, 1929 to 71, 42 years, the debt grew from 17 billion all the way up to almost 400 billion. That's a 22 times growth on debt. On debt. That's the amount you owe on debt. 22 times it went up. Then, in 1971, President Richard Nixon took the U.S. off of the gold standard. And again, regardless of where you live in the world, this is important because the U.S. is the reserve currency of the world. And coming off of the gold standard was really the catalyst that propelled everything forward. Now, the U.S. had already been increasing the money supply in unlimited printing. And they've already been piling up debt. And so it wasn't like a night and day coming off the gold standard, but basically it meant that the reins are off. Now they can print as much as they want. And so from 1971 until 2008, that's 37 years, the debt grew from almost 400 billion to 1,000 billion or $1 trillion. That's 150 times. So in 42 years, it went up 22 times, which is crazy. But then in less time, 37 years, it went up 150 times. Imagine that. And that's as soon as we got off the gold standard and the gloves were off and they could just go for it. And then it gets worse. From 2008 until 2018, in 10 years, the debt grew from 1,000 billion to 22,000 billion or 1 trillion to 22 trillion. That's not actually 250 times. Sorry, that's a typo. It's actually 22 times. So you can see we added we added $21 trillion just in that time period. All right, so that's how fast things started escalating. Now, if you look at it like this, it's a little bit easier to see. We call this a hockey stick. This is the debt hockey stick because it goes straight up like this. A hockey stick would go up a little bit straighter, but you get the idea. And you can see from this chart that the amount of debt stayed relatively low. I mean, comparatively, you can see that. And then right around we got off the gold standard, you can see it just skyrocketing. I mean, when you look at it like this, it really puts it into perspective. Now, I'm talking about $22 trillion of debt. Now, what does that mean? I mean, they use these numbers all the time. What does that even mean? So I put this together just to give you like a little bit of reference. Like I was trying to put things in perspective. So look at this. So 1 million, a million seconds is equal to 11 days. 1 million seconds is 11 days. But 1 billion seconds is 31 years. So when it's the difference from 1 million to 1 billion, I mean, look at that. From 11 days to 31 years. And the difference from a billion to 1 trillion goes to 31,000 years. 31,000 years. That's how big a trillion is. So when they start throwing out 22 trillion, oh, what's 1 or 2 trillion? Well, that's what it is. And you can see from the graphic there, like a 10,000 stack, a million is just like a little stack on the ground. 100 million would be a pallet. A billion would be a couple of pallets. And then look at the trillion. It's like a football field full of pallets. I mean, it's just amazing the amount of debt and money that's sloshing around. Now, what happens is the Fed just keeps printing money. They print money into debt. They also allow the banks to loan money, debt, create money by loaning it as well. But you can see again from here, this is from the Federal Reserve, this chart right here, and this is the amount of money that's been created. This is the money supply. And you can see this going up. So you can see from 1959 to 1971, it didn't really move. I mean, it had a little bit uptick, but you know, it was kind of gradual. But then you can see from 1971 to 2008, it just kind of took off, just kind of went up straight. And you know, what have they been doing? Well, this is how everything gets done. This is all the welfare benefits. This is all the road constructions. A good majority of it is warfare spending. We're a warfare state. We're a welfare state. We spend more just on our military than the next 10 countries combined. So we're the number 1 superpower. If you take the number 2, number 3, all the way to number 10 superpower, add them all together, we spend more than that. It's crazy. I don't know why we're doing it. But anyway, that's where they're printing money. They're piling up debt. They're paying for that. Not only are they paying for that, they're also borrowing money. And then on top of it, because now nobody's left to buy the debt, they're printing money to buy their own debt, the government. That's called QE, quantitative easing. If you want to know more about that, just Google it. Oh, and by the way, these are super deep subjects. I try to make these like really easy to understand. Sometimes people kind of want to criticize me in the comments because it's too simplistic. I just try to make this as easy to understand. If you'd like to know more about any of this stuff, Google is your friend. Go on to Google. Also, in the comments, just leave the timestamp of the section I was talking about and just say, hey, you know, this part right here, I liked it. I want to know more about it, whatever. And put the timestamp. That way I know what you're talking about, and I can answer that for you, okay? So leave me the comments and give me a thumbs up on that. Now, that's the amount of money that's increased. Now, as you probably learned when you were a kid, it's very simple. Supply and demand. Supply and demand. If supply goes down but demand goes up, the value goes up, right? It's easy. So just like that, the opposite is also true. When you have more supply and demand goes down, the value is less, all right? It's basic. It's easy enough for a kid to understand, but somehow these central bankers grow up and they forget about that. So the more there is, there's less, the less it's worth. So as they continue to print more dollars and put more dollars into circulation, each dollar is worth less. That's it. So, you know, it's very easy for us because we live in this dollar-denominated world to think, oh man, houses are so much more expensive than they used to be, or cars are so much more expensive than they used to be. The reality is gas isn't more expensive today. It's that it takes more dollars to buy the same amount of gas. Think about that, right? It's not, the gas isn't more expensive, your dollar's worth less, so it takes more of it to buy it, all right? Now, a very good illustration of this is all quarters and dimes were pre-1965. Before 1965, they were silver. And in 1965, you could buy a gallon of gas for a quarter. That's how much a gallon of gas costs, a quarter. Today in California, it's almost $4 a gallon. And if you had a pre-1965 dime that's silver, it's worth enough to pay for 1 gallon of gas today. That means that same amount of silver paid for 1 gallon of gas in 65, and it pays for a gallon of gas today. It's the dollar that's changed, all right? So you got to look at it totally different. Now, what happens by this, because they've inflated the debt, they've inflated the money supply, and the more they inflate the money supply and mess with the interest rates, it creates these boom and bust cycles over and over and over. They inflate the money, they lower the rates, we go into a boom. They lower the rates and contracts the money, it goes into a bust, on and on and on. And you can see this right here from this chart. So from 1929 to 1950, we had a 70% decline, 70% from 29 to 50. Now it bounced and then it kind of came back up. That's what we call a cyclical bear market. From 1968 to 1982, we had another one, a 66% decline. And from 1997 all the way through 2009, we had a 65% decline. All right, so they just continue to create these asset bubbles. So they, well, I'll get into that in a minute. I'm going to explain to you how they create these asset bubbles, so I'll get to that. Now, but just know that we continue to have these bubbles and these boom and bust cycles over and over. Now, the reason why it's important for you to understand this is so that you can get ahead. Like, I know, hey, when we're in a boom, I'm going to make as much money as I can. I'm going to put it away. I'm going to protect it. I'm going to guard it. That way, when we're in the bust cycle that I know is coming, because we constantly go through these boom and bust cycles, I'm going to be able to buy things super cheap and come up even harder. I'm going to talk about some strategies for that at the end. We're going to talk about that. Wealth transfer is coming to you. All right. Hopefully you're liking this. Make sure you give me a thumbs up. Now, then fast forward. The last big correction we had was 2008. We had a financial collapse, and not just in the United States. Now this time it affected the entire world. And again, like I said, no matter where you're at in the world, the United States financial policy really affects you. And it all started right here in the United States, but it was contagious to the rest of the world. Now, what happened is controlling the interest rates, controlling the money supply creates a bubble. So what they did is the Fed lowered the interest rates. The Fed lowered the interest rates so low that it made borrowing money almost nothing. And then what they did is they wanted to promote home ownership. So they created all these loan programs to encourage people to buy homes. Not just regular loan programs. They created like what's called subprime loan programs. That means people with basically no credit, bad credit, could buy homes. And not just one home. They could buy 2 homes and 3 homes and 4 homes, right? And because the interest rates went down and anybody could buy a home, well, guess what happens? Home prices rise, right? So now all of a sudden the home prices rise and we have this big bubble in housing. But think about that. It wasn't a natural bubble. It was created because of those economic policies. So it's what's called the law of sowing and reaping, right? Whatever you sow, you reap. When you sow, artificially low rates and give loans to anybody, artificial loan programs, then you're going to reap a bubble. That's what's going to happen. Everyone's going to buy, and it's going to make the prices go up. Now, you all know how that turned out. We had this massive housing crisis all throughout the United States. Everyone's losing their homes. But then that continues to get worse and worse. So then the banks start going bankrupt. And then, this bank bought debt from this bank. So now this bank's affected. And then, the banks in Europe and Italy and Germany, they bought the bonds from the banks in the United States. And now they're affected. And the entire world is about to collapse. Now, we can, again, not trying to dive too deep into this. If you want to know more, leave me in the comments. But and like I said, Google's always your friend. Now, what happened is there was all these financial instruments, and the banks were going to go under. And as we know, the government stepped in. They let Lehman Brothers walk, but they stepped in. They bailed out all the banks. They printed, hundreds of billions of dollars, TARP money, gave it to the banks, and basically saved them. But they saved the banks. The homeowners still lost their homes. The homeowners still went bankrupt. The banks made all this money off of that, and then they got bailed out. So they got bonuses while everyone else got bankrupt. And now, you and I, if you're in the United States anyway, we're paying the tab. Now we're paying the taxes for that. But that's a whole other issue. I'm not going to get into that. But what I want to tell you, and I'm going to get to it, is I'm going to tell you it's getting worse, unfortunately. However, we have a plan. We have a plan to make a lot of money with this if you do it right. So I'm going to tell you that. But first, it's getting worse. So from 2008 until now, just in the last 10 years, we've added $11 trillion of debt. And again, you hear these numbers thrown around all the time, and it's hard to imagine what that is. But to put that into perspective, that's more debt in the last 10 years than all the debt that had been accumulated since the Federal Reserve was put into place in 1913 until 2008. If you add up all the debt that had been accumulated since the beginning of the Federal Reserve till 2008, just what they put on in the last 10 years was more. I mean, it's just unbelievable. Combined, right? And as you can see from this chart, that's where we're going. So you can see the crash that we had, the first crash, the second crash in 2008, and look how much higher it's going. And the way that bubbles work, boom and bust cycles work, is the third bubble is typically the biggest, and unfortunately, because it's the biggest, that means it's crashed the hardest. So that's what we have coming up. Now, we don't know when. Timing it is always what I believe, impossible piece. Nobody can time it. A lot of people thought it was going to come sooner. Some people think it's coming right now. I tend to think we might have into next year, but we don't know. It could happen right now. We need to be prepared. So we always need to be prepared. So I'm going to give you actionable information. Make sure you do that at the end. But what we're going to see is we're going to see this happen at some point. Now, it all boils down to the money, right? All this boils down to the money. So it comes from runaway government spending. It comes from getting off of a hard, sound money. So for 5,000 years, most economies in the world had been backed by gold, which was a commodity, a limited amount of quantity. It's very hard to get it out. There's a true cost of capital to get it and accrue it and so forth. I've talked about that. And so for 5,000 years, we've been on that standard. And right now, we're about 47 years into this new experiment called fiat. In this fiat experiment, fiat means money that's not backed by anything. There's nothing there. So now we're into this experiment, and what that does, the reason why they like to have this fiat money is because now they can have as much as they want. They can inflate it, they can manipulate it, they can do whatever they want, as opposed to being stuck, on gold and being stuck with something like that. So it all boils down to the money. So if we could return back to a hard, sound money, we could fix the problem. All right. So, the Fed, the bankers, the government, the president, all these people, they're always trying to come up with all these short-term solutions, right? They want to put a Band-Aid on them, but they don't want to get to the root of the problem. And the root of the problem is the money. The money is not hard, it's not sound. All right. So that's where Bitcoin comes into play. All right. Now I'm not going to get super deep into Bitcoin because that's not what this video is about. But Bitcoin was designed to be hard, sound money, and it was actually created as a direct response to the 2008 financial crisis, right? Satoshi Nakamoto, the cypherpunks, the group of them, whoever they were, they saw this happening. They saw how all this endless money supply, all these risky financial assets caused basically the entire financial world to kind of melt down, and they created this as a financial tool to be used to bring us back to this hard sound money. And fun fact, if you didn't know this, but in the Genesis block, so that was the very first block that was mined. So the very first block that was put onto the Bitcoin blockchain, there was actually a message put in there, and it said January 2009, the chancellor is on the brink of a second bailout for banks. That's what they actually put. And so that's how you know it was actually done in response to that. So that's in the code, and basically they're just mocking this fractional reserve banking and how they've wrecked the system and how they continue to have to get bailout after bailout after bailout. Now, like I said, unfortunately, there is going to be financial pain ahead. We know this. I mean, we know it. We just know that we can't continue to print up debt. We know that we can't continue to service the debt. We know that markets ebb and flow. We know there's booms and busts. I mean, we just know that. I showed you charts all the way back for the last 100 years, and you can see boom, bust, boom, boom, bust. And if you look at the chart that I have on the screen right now, I mean, an elementary student could tell you what's probably coming next, right? Just pattern recognition. So we know it's coming. We don't know when, but we know it's coming. And like I said, the third bubble is usually the worst, so it's going to be pretty hard. And so that's why it's just important to be prepared. So how do we be prepared? How do we survive this collapse? And really, I don't want to just survive. I want to thrive, right? So I'm going to tell you how to thrive, but we want to survive, right? So the first thing is this is like the best market that we've had in a long time. We've been in the longest bull run, maybe the longest bull run in history. So you need to be out there. You need to be making money as much as you can right now. If you're not making money today in this market, it's going to get really hard for you. So hopefully you're making money. Hopefully you're making as much as you possibly can, and you're trying to save and accumulate as much as you can. You know, for me personally, I'm trying to make as much as I can. I'm also trying to reduce my expenses as much as I can so I can stockpile, right? I want to save for the winter, right? I want to stockpile so when I do go through that winter, you know, I make sure that I'm safe through that. What I also want to do, now that doesn't mean I want to put everything in cash. I want to stay in positions because I want to continue to ride that wave up. I don't know how much longer it's going to go. It could go another 30 days. It could go another 30 months. And I don't know that. So I want to make sure that I'm still getting the upside. So what I want to do is I want to hedge my positions. All right, we can do that by a couple of ways. There's some complicated ways where you could, you know, use option strategies and stuff like that to protect your long positions. Then you can sell against them. So if it goes down, you make money, which offsets the loss on your long. Those are a little bit more complex. The easiest way to do that is through asset allocation. And I believe that's the number one secret to success in investing is asset allocation. You need to make sure that your assets are allocated across multiple different, hopefully uncorrelated assets. All right, this is what the smartest money managers in the entire world do. They're smart enough to know that they don't know. So that means that if the real estate market crashes, maybe the treasuries and the bonds do better. So I'm losing money here, but I'm making money here. Or if the US dollar fails, Bitcoin goes up. And so, you know, even though I'm losing here, I'm making money here. You don't want to put everything into one asset because then it's like gambling. You don't know. So we're trying to hedge. We're trying to allocate our assets. And then within those assets, we want to diversify. So I want to have real estate, for an example. I want to have real estate in my asset allocation, but I want to diversify in that real estate. So maybe I want to diversify across different pieces of the United States. So maybe I want to own properties in California, Florida, and Texas. Maybe I want to own some properties out of the country as well. So I'm diversified. All right, and then I want to make sure that I have like even uniform position sizing throughout the diversification of the allocations, if that makes sense. Now, I know this is a little bit complicated, and that's okay. I have a guide that's going to help you out. Now, moving right along. The question that you may be asking, because typically I'm talking about Bitcoin and cryptocurrencies, is Bitcoin uncorrelated? And the question is, it could be not. We don't really know. We haven't really seen a financial crash since Bitcoin's been out. And you have to understand that non-correlated and uncorrelated are not exactly the same thing. And so what that means is correlated mean, do they move together? Are they non-correlated or are they uncorrelated? And so, you know, being non-correlated is not the same as inverse. So that means as one market goes up, it goes down, right? We don't know. We haven't really seen it. But what we do know is that there are differences in what drives those assets, right? So you want to look at why does an asset go up? Why does what makes a real estate asset go up? What makes what makes the treasuries go up? What makes my bonds go up? And then you want to make sure they have different fundamental drivers, different reasons why they would go up. So that way, if the economy is doing super good, this goes up and this may go down. But when the economy crashes, then this goes up and this goes down, right? And then, you know, we can also look at other countries right now over the last year, like Turkey, Venezuela, Argentina, Zimbabwe, where their currencies are crashing. They're seeing massive, massive crashes in their currencies, and they've been flocking to Bitcoin like crazy. As a matter of fact, they're paying 300, 500,000% premiums to buy into these because of their currency. So we have seen in other countries, it's been really good non-correlated asset as far as currencies go. All right, so we want to make sure we have asset allocation. We want to make sure we're in non-correlated assets. We want to have good position sizing. And what that's going to do is that's going to allow us to preserve and grow our wealth. Like I said, we don't want to just put it all under the mattress. We want to preserve it. We want to make sure that it's safe. It's in safe investments. It's in investments that aren't tied together, non-correlated. But we also want to continue to grow it. Like I said, this could go on another 30 months. We don't know. And so I want to make sure that I'm still receiving the upside, but at the same time, I'm protecting it. And again, we do that through asset allocation. And what that's going to do is that is going to allow us to scoop up these discounts when they come. All right, you know what? Like one man's pain is another man's gain. One man's loss is another man's treasure, right? So the image I have on the screen, "The Sell of a Lifetime," that's a book that I read. I'm not trying to shill it to you at all. Harry Dent is an economist that I've followed for a really long time. He's a little bit of a doom and gloomer. I like to hear that. I like to hear both sides of the argument and form my own. You should always do that too, right? You don't want to just hear the stuff that you already know and that you believe. You want to hear both sides of the argument so you can make your own informed decision. So I've followed Harry Dent for probably 12, 14 years. He's super smart. He's been calling for this market to crash for quite a while, and it hasn't. So he hasn't been completely accurate here. But I believe that's because the fundamentals show that. We just don't know how much longer they can keep this charade up. However, the point that he makes in the book is that we are going to have the sell of a lifetime. When this next market crashes, it's going to be bad for a lot of people. But if you have money left over, if you've preserved your wealth, you're going to be able to come in and scoop up deals better than you've ever imagined, right? And that's the real wealth transfer. So when other people lose their wealth, other people receive them. So people will be forced to sell their houses, sell their cars, sell whatever at like dirt cheap prices. And then if you have some what we call dry gunpowder, you can come in and scoop up those assets at super low prices. And if you have a good enough timetable, if you can hold for years until the market rebounds, you're gonna make crazy money. I know a real estate guy. Most of you guys know I've been in the real estate industry for a long time, and one of the guys that I've worked with, he didn't get in until about 2010, which was about a year and a half after the big real estate crash. And he was out in Arizona, out in Phoenix, Arizona, and he got his start there. And he hooked up with like a couple of pretty wealthy guys and got a couple $1,000,000. And he started going to the courthouse and just buying these houses up, like 10 at a time, 20 at a time, and buying them for 20, 30 grand each. Now those same homes are going for 200 and 300,000 each. All right. So he made an enormous amount of money by being able to have wealth at the sell of a lifetime. All right. All right, so hopefully all that makes good sense to you, and you understand that you know, there's danger ahead, but it can also be the biggest opportunity that you may have ever seen. So you just got to be prepared for it. So I made this guide for you. I made this guide. It's free. Just look at the link down below, click on it. You can download this guide as a PDF guide, and it will tell you how to build the perfect portfolio so you can withstand the financial crash ahead. It's going to talk about allocation, asset allocation basics, tell you how exactly to find non-correlated assets. I kind of hinted on it. There's a lot more in there. How to build your perfect portfolio, how much to put into each position, all that. And then more importantly, how to keep it all in sync and all tuned up. Super important. Like I said, this is the #1 secret for investing that most people just don't know. All the best money managers in the world use this. So just go to the link below, check it out. And I hope that brings a lot of value to you. Please share this with everybody that you know. There's troubles brewing, man. It's going to be tough, and I just want to make sure everybody's protected. So share the word, share the guide with everybody. Do the work. Leave me comments below. Ask me questions. Like I said, if you want a question, if something sounded really good to you, you were excited about something, you were scared about something, information, just put the time code in there so I can respond accordingly to that. Make sure you give me thumbs up on this. Subscribe if you're not already subscribed, and that's it. Hopefully you enjoy the guide, and I'm done for today. To your success. I'm out.